There's a debate that splits investors harder than almost anything else in finance: dividend investing versus index funds. And most people arguing about it online have never actually looked at the underlying research. So today, instead of opinions, we're going through the actual data: historical return studies, real numbers from S&P Dow Jones Indices, Hartford Funds, and Ned Davis Research, and real examples you can check yourself. If you want breakdowns like this backed by real research instead of hot takes, hit subscribe right now, because that's exactly what this channel does. Let's start with what the data actually says. First, let's define both strategies clearly. Dividend investing means building a portfolio around companies that pay you cash regularly for holding their shares. Think Coca-Cola, Johnson & Johnson, or Procter Gamble, all of which have raised their dividends for over 50 consecutive years, a status that earns them the title Dividend Kings. Index investing means buying a fund that holds the broader market, something like the S&P 500, and capturing the market's overall growth without picking individual stocks. Here's the first data point that surprises a lot of people. Dividends are already a massive part of index fund returns. According to the latest research from S&P Dow Jones Indices, dividend income has made up roughly 31% of the S&P 500's total monthly return since 1926 through February 2025. A separate study from Hartford Funds and Ned Davis Research found that from 1940 to 2025, dividends contributed an average of 33% of the S&P 500's total return. In other words, if you own a plain S&P 500 index fund, you're already getting substantial dividend income. You're just also getting the growth of every non-dividend paying company at the same time. That contribution isn't constant though, and this is where it gets genuinely interesting. Hartford Funds research shows that dividend contribution varies enormously by decade. In the 1970s, a decade of high inflation and weak growth, dividends made up around 70% of the S&P 500's total monthly return. In the 1990s, during the dot-com boom, dividends contributed just 15% because price appreciation was doing almost all the work. And in the 2000s, often called the lost decade, the S&P 500's total return was actually negative, but dividend income alone still added roughly 1.8% annualized, acting as a cushion during a decade when stock prices went nowhere. Now here's the actual head-to-head data. According to Hartford Funds and Ned Davis Research, over the past 50 years, dividend-growing companies specifically, not just any dividend payer, but companies that consistently raised their payout, delivered an average annualized total return of 10.2%. That compares to roughly 8% for the average stock market return over the same 50-year period. On the surface, that looks like a clear win for dividend growth investing. But there's an important nuance the same research uncovers. It's not the highest-yielding stocks that win. When Wellington Management and Hartford Funds broke dividend payers into 5 groups based on how much they paid out, the second highest quintile, not the very highest, outperformed the S&P 500 most consistently across 9 decades of data, from 1930 to 2025. The highest-yielding stocks often underperformed because an unusually high yield is frequently a warning sign of a struggling stock price or an unsustainable payout, not a sign of health. For a real-world recent example, the Schwab U.S. Dividend Equity ETF, ticker SCHD, one of the most popular dividend growth funds, actually underperformed a standard S&P 500 index fund over the past 1- and 3-year periods, according to Motley Fool's analysis of Y-charts data. But over longer stretches, its returns track much closer to that historical 10% plus dividend growth average. That's a useful real-time example of something academic research shows constantly. Dividend strategies and index strategies can trade leadership for years at a time, depending on whether the market is in a growth-led phase or a value-led phase. So what actually explains the gap between dividends look great historically and index funds usually win in pure backtests? Part of the answer is survivorship and concentration. A pure S&P 500 index fund captures every mega-cap growth company that pays no dividend at all alongside the dividend payers. So during growth-led markets, it benefits from both. A dividend-focused portfolio, by definition, excludes the non-payers, which can mean missing some of the market's strongest compounders during growth cycles. There's also a real, well-documented behavioral factor. Multiple industry researchers, including analysts at Hartford Funds, note that dividend-paying stocks have historically shown lower volatility, a beta of roughly 0.88 to 0.91 relative to the market's 1.0, according to data compiled by both Hartford Funds and S&P Dow Jones Indices. Lower volatility doesn't just look better on a chart, it correlates with investors being less likely to panic sell during downturns, which matters enormously for actual, real-world long-term returns, as opposed to theoretical, back-tested ones. So, which one wins? The honest, research-backed answer is, it depends on the multi-decade market environment you're investing through, and it depends on whether the lower volatility of dividend investing helps you personally stay invested longer. In growth-led decades, broad index funds tend to pull ahead. In flatter or more volatile decades, dividend income has historically provided a meaningful cushion. Both strategies, importantly, rely on the same underlying engine, reinvested dividends in compounding, just distributed differently. This channel breaks down investing debates using real data instead of takes designed to go viral. If you want more research-backed breakdowns like this one, hit subscribe and turn on notifications. I'll keep digging into what the numbers actually say.